I once made a $2.1 million profit in 30 days trading on the floor of the CBOE. I'm gonna show you how to apply the same concepts to your option trading right now. I'll break down the step-by-step of how to get started options trading as a complete beginner. This is going to be a very comprehensive guide because I'll condense my more than 30 years of options knowledge into this one video. So this is how a normal trade would go. You have X stock. Let's say it's currently trading at $100 and you think that it might jump up to 150. What you can do is just buy shares of the stock and hope it goes up. And if it turns out that you're right and it goes up to, let's say, $150, great. You make a profit of $50. But let's say the stock instead goes down to $50. If you bought it at 100, you would have a $50 per share loss. The money you make is fully based on how the stock moves. So how is buying a call option different from buying a stock the normal way? An option gives you the right, but not the obligation, to buy shares of a stock. So there's a few things associated with a call option. First off, a call option gives you the right to buy stock at a certain price, which is known as either the strike price or the exercise price, up until a certain time in the future, which is known as the expiration date. And there's a contract multiplier. So each call option gives you the right to buy 100 shares of stock. So let's say you bought a call option for $1 that had a strike price or an exercise price of $50 and the stock was trading $45. The $50 strike price, that's what gives you the right to buy stock at $50. Let's say the stock were to go to $54. Your call option that you bought for $1 would now be worth at least $4. The reason being is because you have the 50 strike call, so that allows you to buy stock at 50. If it's trading 54 in the open market, it's now worth at least $4. There's your profit. You paid $1, it's worth at least $4. That's a $3 profit. Or remember, $3 times 100, because the multiplier is 100, $300 profit. We need to talk about the expiration. Every single option out there, call or put option, has a finite timeline to it, meaning it might be out there for a day, a week, a year. And when that time frame is over, either that option is going to be worthless and it's thrown out in the garbage, it's not worth anything, or it turns into stock. On the put side, let's say there's a stock that's trading $50 and you want to buy a 45 strike put for $1. That 45 strike put gives you the right to sell stock at 45. Let's say the stock goes down to 40. The difference between where you can sell the stock of your exercise or strike price at 45 and 40, that's now $5. If you paid $1 or $100 for that put option, that is now worth $5. Because remember, you can sell stock at 45 and now buy it back in the open market at 40. That would be a profit of $400. Let's talk about implied volatility. It sounds pretty complicated, but think of this. Just like with any commodity out there in the world, regardless of what it is, prices are based on supply and demand. The more supply there is of something, the lower the price. The more demand there is of something, the higher the price. That's what implied volatility is. If you're looking for a faster track to learn trading while accelerating the learning curve, you can grab a copy of our quick start guide to options trading by clicking the link in the description of this video. Also, click on this video over here to learn about the only trading strategy that you will ever need. I'll see you in the next one.